So I've heard a lot of chatter lately about assumable loans because of the spike in interest rates. So let's discuss what an assumable loan is and the pros and cons. So government loans are currently able to be assumed, FHA, VA, and USDA loans. Basically, the seller would transfer the current loan to the buyer. The buyer would have to work with the seller's lender or servicer to get approved to take over the loan. And then the main reason someone would do this is because the seller's loan has an interest rate much lower than the current market rates. Basically what we have going on right now in the market. Now, there are less closing costs involved. Typically an appraisal's not needed, and it could be a very quick closing. Sounds great, right? Seller would be able to certainly market this and entice buyers with that lower interest rate. Yes, but there is one catch that we all need to understand. So let's say there is a seller right now that has a VA loan with a 3.25% interest rate, and the mortgage balance is $250,000. And even if you're not a veteran, by the way, you can assume a VA loan. Well, herein lies the problem. The sales price for the home, let's say it's $500,000, right? That's $250,000 that must be covered by the buyer, right? Most buyers are not going to have that amount of funds to cover that delta, and there are not any second mortgage options really out there to cover it either. So this is the main issue with assumable loans right now. Could there be a scenario where this works out between the seller and buyer? Sure, but the preponderance of times it's likely not going to work, and we're not going to see a flood of assumable loans happening anytime soon. So hopefully you found that valuable information if somebody does ask you about assumable loans, which probably will happen in the near future. Thanks, guys.